Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, I'm going to give you a glimpse into what I call rich people problem world, right? Or rich people problem land. So a lot of people think like, oh, if you have all your debt paid off or you're making a lot of money, like all your problems go away. And that's actually not true. All you do is transition into a different set of problems, right? And this is very hard for most people to imagine because they're experience what I call, I don't want to even use this word. I probably should say non-rich people problems, but it doesn't sound as good. They're experience what I call poor people problems, okay? And what's the difference between poor people problems and rich people problems? Well, poor people problems goes like this. Like you're sweating at night and you're like so worried to death, how am I going to make it tomorrow? That's like poor people problems, okay? Rich people problems is that like you have a problem and then you kind of get annoyed and then you can go to sleep. So I'm going to give you an example like of this, okay? So number one is the savings account. Like if you have lots of money in a savings account, you're like kind of like, oh man, this kind of sucks because like I know I could be deploying that money because if I have too much money in a savings account, number one, like that's not going to be FDIC insured if it's just all in one bank account. And then number two, it's going to be eaten away by inflation, right? So that's why rich people are always looking to invest their money in something, right? They don't want their savings to be eaten by inflation. That's rich people problems. Another example of rich people problems that I can tell you is when I applied for credit and then I get rejected, and then the reason for rejection was like, you have too much credit. I was like, oh, that's kind of annoying. But I still went to sleep the next night, right? Too much credit, that's a rich people problem. And one of the cool things that you can do when you're in rich people world that like hopefully you'll be able to experience too is you just pull out your smartphone and then you swipe up and then you could just show people how much access to money you have. In fact, I met this Korean gentleman who's been owning commercial property since the 90s, and he offered me like, "Hey, I'll lend you all this money if you got a good deal." And then he just whipped out his phone and then like swiped up and it's like $2 million in his checking account. And I was like, it took me a long time to figure out that that was like a real situation. You know what I mean? Like, what's going on here? Like, why are you offering me $2 million? And once you have all the money in the world, you realize, wow, like you kind of understand that point of view of making people offers so that, you don't have to do all this work to find and source the deal and negotiate and all that. You just want the money to be deployed, right? And I'm kind of like that, but I'm not there yet because I got access to $280,000 in home equity line of credit, so I can swipe up on my cell phone. But I don't have 2 million in my checking account, and again, I'll get there eventually. I'll get there. I'll have actual all my debt paid off, and then one day I'll have 2 million. And then maybe I'll meet someone else, some of you, and I'll be like, yeah, let me just swipe my cell phone. 2 million in my check account. Now I'm not saying I'm making that offer. I'm just saying, what if hypotheticals? That's the real rich people problem territory slash land that we hope to strive to get to, right? And one of the easiest ways to get to rich people problem land, pay off your debt, right? Pay off your debt. Easiest way, right? And so what happens with a lot of people is that even if they have the so-called coveted six-figure job, they broke. They broke, right? So, $6,500 of income, $5,884 expenses, $615 of savings, and if you have that little savings every month and you're making over six figures, it can feel a little bit daunting, right? In fact, if you just type in Google six-figure paycheck to paycheck, right? Six-figure paycheck to paycheck. Um, yeah, Google says many people with six figures are living paycheck to paycheck. 48% of people earning $100,000 or more say they're living paycheck to paycheck. So a lot of people, they're just like, I just need to make more money, and they don't know how to manage it. In fact, if you're in this income range, I'm going to tell you something. You're the prime target for banks. Like banks, a lot of people are like banks like to target poor people. That's actually not true. Banks avoid poor people like the plague, right? They want people who can make money but are kind of bad at managing it. Okay, that's who they lend to. And you kind of go to downtown and see like, wow, there's all these like really big bank buildings. Like every time I go to downtown Atlanta, I always see like when I'm on the freeway, a huge Regents building. It's like, huh, how'd they do that? Like, you ever watch that Family Guy clip about Chase Bank? Is like, huh, Chase Bank, how'd they get that new stadium? Right? That's because they want to do something called income segregation. they'll be like, hey, if you have absolutely no debt, like let's say, you had no debt here, then they'll offer you a credit card here, a credit card there, an auto loan here, an auto loan there, student loan, a mortgage, and then what happens is your income becomes segregated. Okay, your income becomes segregated, and they just making all the money from the interest payments. And not only that, they know that you're not going to pay off debt because they know in your mind that from the culture teaches you this, that you need a savings account. And because you have a savings account, that means that you're not actively applying all your money into debt, which is what we're going to do with velocity banking, right? So two things needed with velocity banking. Number one is a budget. And then number two is a line of credit as our main operating account. So what's a line of credit? All it is a financial tool where we can borrow money, pay it back, and then use it over and over again. That's all a line of credit is, right? So when I look at my cell phone, I swipe up, I could just go to the bank's website, tap a button, and as of right now, I think I have up to $267,000 available to me. So I just click a button and I can literally dump $267,000 into my checking account, right? Would I dump the whole thing? Probably not. Do some people in YouTube land encourage it? Yes, and I don't know why. Okay? Excuse me, you don't want to dump the whole thing, especially to replace your mortgage. And that's what some people on YouTube encourage. I always say do the math. You know what I mean? All right. So now let's go ahead and do this. Your line of credit is your main operating account, and so this is going to be your income. Your income's right here. It's going to stay the same, and so are your expenses. Okay. But what's the difference here? The difference is that you're not going to have what we call savings. That savings account, um, it's kind of going to be there, but not really, right? So at the end of statement cycle for your savings or checking account, kind of like here, it should be zero, right? It comes in, money goes out. That's like what we call the flow of money. And then the ending balance is going to be zero, right? Like I know people would freak out about it. It's like, oh my goodness, I have no savings. Like, yeah, like we're doing the opposite of mainstream finance. If we take a look at Dave Ramsey's like seven baby steps, he's like save $1,000. Like velocity banking, the complete opposite of it is pretty much saving money, right? Saving $1,000. We're not going to do this. We're going to just pay off our debt, okay? And then what we're going to do is have something called cash flow, which is what we're going to reduce our debt amount by. And what we're going to do is once we move some of our debt into the line of credit, we're going to put our entire paycheck, the entire $6,500 into that line of credit and the expenses out. So all the difference between the average American and the velocity banker isn't the paycheck size, right? Because some people, if they use their money inefficiently, all they think about is just I just need to make more money, and that's not true. It's about how you manage your money, right? To velocity banking is a debt payoff strategy, it's a cash flow management strategy, and so this is what we're going to do. So we're going to make an unrealistic assumption here, is that we have access to a free and clear line of credit. And that's not true. Like, no one's going to have access to a free and clear line of credit. Let's be realistic, right? Because, number one, if you get a new line of credit at this stage where you only got like this much savings available after all expenses are paid, they call it the DTI, debt to income ratio. Um, Banks are going to look at that and like, I'm not going to lend you a line of credit. And why do you know that they're not going to lend you a line of credit? Because banks don't lend money to people who need it. Why do you think I have all this credit? Why do you think I have over $527,000 in lines of credit? Because I understand what they're looking for, right? The bank is kind of like a vampire. The way that you get the vampire's resources, if they happen to have resources that you want, is that you just say, "Hey, look at me. I'm a guy with all this fresh blood circulating. No one's ever sucked the blood off of me, and I don't even need money, right? Like, so you can suck the blood off of me." That's how you got to think of the bank, and the bank sees like, "Hey, no one's sucking the blood off of this guy and making pretty good income." That's when they'll start to lend you lines of credit, and obviously you want to borrow it then pay it back immediately, right? Like you don't want the bank to take advantage of you like they take advantage of so many people. Okay, like again, remember that Family Guy commercial with Chase Bank? It's like, how'd they get that stadium? I don't know. How did they get that stadium, right? So very important to remember that banks don't lend money to people who need it. So uh, you got to get it before you ever do need it. Okay, but let's say we did have a line of credit available. Okay, and again, if you want to see an actual situation where this line of credit is maxed out, because that's probably the most typical situation. But if you have all this debt before you like learn velocity banking, go ahead and join the YouTube channel. It's only 99 cents, and we got a live stream there where we went over someone's case where we paid off 22 debts. We went through a simulation paying off 22 debts and with the maxed out line of credit, and we did it in 1 hour and 30 minutes. It was crazy, okay? So that's if you're interested, but let's assume that we have a line of credit available for us, okay? So what we're going to do is start moving our high interest rate credit card debt, cheat code. Just if you want to know which debts to move your line of credit, it's just usually the short-term loans and the high interest rate credit cards, okay? So we have $30,000 of credit card debt here. And so what I'm going to do is start moving the $30,000, right? Not 3,000, whoopsie, $30,000. And this is kind of like a debt transfer, right? That's all it is. We're not getting rid of the debt. We're just doing a debt transfer. And by moving this debt, listen, look at this, $615 to $1,500 of cash flow in one swoop. Okay, just by simply doing a debt transfer. And now what I'm going to do, okay, is go to the next month's balance. So equals G2 plus H2 minus 1536.39. And then our interest is going to be calculated by what we call the average daily balance, right? What's going on here? Okay, by the average daily balance, right? And then we multiply it by the interest rate, which is 0.08, right? And you might be like, $2,000 of interest, that's insane. No, we divide by 12 because it's in annual interest divided by 12 to get the monthly interest, okay? So it's not as bad as you think. I didn't understand this at all before, like, I learned velocity banking, because whenever I saw 30% credit cards, like, that's insane. They're charging 30% per month. No, it's 30% divided by 12 per month, which is not as bad as you think it would be, right? So this 8% is not really that expensive money, but it's, you're paying a little bit to the bank, okay? And so now you see that in 21 months, let me go ahead and do this, 21 months, this is all paid off, right? So 21 months, and then this is 30K, right, 30K. And then now we got to pay all these other ones off, right? Well, that was easy. Auto loan 1, auto loan 2. In fact, I was really surprised today to find out that used auto loans are at 12% interest rate. Let me just do a quick Google search here. Used auto loan interest rate. And yeah, well, 9.36, 13.92 for if you're like in 600, and then 18% for subprime. And in fact, there are actually dealership. Oh, deep subprime score, 21%. In fact, there are actually dealerships out there that prefer only working with subprime customers because it's like the worse your credit is, the more you get to charge, right? And that's kind of how like real estate works in a way. So it's like the worse the neighborhood, the more your rate of return is, right? Like the A-class neighborhoods, technically, if you know a concept called cap rate, have the least return out of all the real estate. You think of like, oh, the luxury real estate gives you the most return. When it comes to rentals, the sweet spot is like the B and the C, like B and C class properties. Yeah, I'm going on a tangent here, but I'm just saying that if you have a lower credit score, if you're a lender, you can actually charge more and make a lot more money. And you can see here that the credit unions and the banks actually they offer pretty good deals, but it said the average is 9, 13, 21, 18. That's pretty crazy. All right, so let's go ahead and do this. Now, in 21 months, okay, so let me just do this. 21 months, what's the current balance of our loan? So I just do 21, 21, 21, 21. And then, so it's auto loan 1, auto loan 2, and then as you can see right here, we have the total interest that's been paid so far, which is kind of a lot. It's, what's the sum? Let me just sum it up, okay? So let me do this, this, this. So we paid 24 grand of interest so far in 21 months, right? It's kind of a lot. It's kind of a lot. Okay, so now we're going to go ahead and do this, which is we're going to recover our cash flow. And we usually do this with something called the cash flow index to figure out which debts we move to the line of credit. And since these are the lowest numbers of that cash flow index, and if you don't know how it works, it's just lower the number. That's the one you want to pay off first. And these are in the 30s, which is below 50, where we want to focus on attacking those. Then we can immediately recover the cash flow. So let me go ahead and do this, and I am going to, whoopsie. let me just do this. So this would be G2 plus G3 and 25 grand. So we're going to move 25 grand into the line of credit. Again, auto loan 1, auto loan 2. Okay, let's go ahead and do that. And let me go ahead right here. And now I'm going to copy and paste. Or not copy it. I'm going to type it in. 25145.88. Okay. So now we're going to do this, and guess what happens here by moving those two auto loans into the line of credit? Well, blam, okay? So now our cash flow is $2,281, 2281, okay? So now what we do is we just go here, and then instead of minus this one, it's minus 2281, okay? So let me just take a look here. Yeah, 2281, and let's go ahead and copy and paste these numbers. All right. So we can see how long it takes us to pay off these loans and auto loans into the line of credit. And then now we see right here in month 33, those two auto loans are paid off. Month 33. Okay, cool. So 33 months. And then what's 30 plus 23 plus 13? 66K. Okay. All right. And then now what we do is we go back here, and then we're going to go ahead and put 33 months here, 33 months there. The current balance of this is 0, 0, right? And so we see now that we paid about 35K of interest, and along with the interest cost of the line of credit. All right, so now what we're going to do is we see here that the cash flow index of the student loan is 69. Haha, joking, whatever. I'm just kidding. All right, so let's say right here, okay, 31 grand. 31 grand is the current student loan balance, right? And so we can put in the line of credit. What's actually more optimal, I'm going to be honest with you, is what we call the chunking method, or splitting it up to pieces. So if we just moved some of the line of credit into pieces, that would actually be more optimal. I'll demonstrate that with the mortgage because it's easier to demonstrate. But we can move this into line of credit. I think it should be fine. We might pay a little bit more by moving it to line of credit, but you're kind of saving maybe a couple $100 by, or maybe 1,000. I don't know. But let's just move this to line of credit. 31442.73. Okay. And so now let's move that student loan into that line of credit. And this $454 is now 0. And $2,735 of cash flow. Holy bazookas, right? Holy bazookas. That's what we used to say when we used to watch Baywatch back in the day. I'm just kidding. I never watched Baywatch. I just knew of it. All right, so let's go ahead and do this, and um, let's go ahead and 2735.19. Okay, 0.19. That's our new cash flow, and then we just copy and paste here. We just copy and paste here. Copy and paste. Copy and paste, and let's see how long it takes us to get rid of our student loan. So it's 45 months. Pretty sweet. 45 months to get rid of our student loan. And 45 months. And then, so now, okay, that's 66 plus 40, that's 106K. And our mortgage, okay, so our mortgage is at 3%. So it's 3% mortgage at $300,000 at 45 months. So now we go back to the loan calculator right here. So it's 45. This is now gone, and now we've paid 43 grand of interest. Again, interest is rent on our money. We're renting all of this money. And so even though we're doing velocity banking, you see kind of like, hey man, there's so many like wasted opportunities here. And think about someone who does not pay off their loans early, right? Just think about that. In fact, let me just go ahead and do this. This is going to be crazy, okay? What if I brought all the loans to the full terms? So this is going to be 360, oopsie, 360. This is going to be, I think, 120. Then this is going to be like 60, 60, right? And hold on. Did I do this right? 4,000, 4,000. So $178,000 of interest, okay? So now let me reverse that. Yeah, okay. Okay. So now 45 months, Okay, so we're month 45. How do we get rid of this $275,000 balance? How do we get rid of it? Okay, well, we don't want to. Well, there's two ways that we can pay it off. One is we just simply just make extra payments to the loan, right? $2,700 to the loan, right? Direct payment, and that's the default option. So my question to you is everybody knows that they have this option of directly overpaying the loan. Why haven't they done it? That's because directly overpaying loans makes it difficult for you to maintain your cash flow, right? You have to know the exact amount that you're paying. Whereas if you're just moving some into line of credit and you dump your entire paycheck into it, then you don't really have to know, just as long as you're cash flow positive, right? And I've actually been cash flow negative in some months. Yeah, I get it. But the cost of not thinking is so, it allows me to apply every single dollar into my debt if I just kind of move some of it into the line of credit. All right. And the thing is that we don't want to move all of it into the line of credit. That's a no-no, right? We don't want to do that. And let me show you what I mean by that. Okay. So I'm going to open the velocity banking calculator. All right, take a look at this. We got the Velocity Banking Calculator up and running, provided by Renatus. So if you didn't know, I actually sell Renatus education. I'm going to get more into it. So if you see like videos like how to join this cult, like learn how to be part of the cult, that's just me talking about Renatus, right? And Renatus is not a cult, but I might be a cult leader. Wink, wink. So here, what we're going to do is we're just going to type in all the information. And Renatus is just to kind of so that you know what I'm talking about is an educational company. It's an online platform where you can take classes. Not only do they offer classes on velocity banking, but other topics about financial literacy, real estate investing. So the reason that I resell, they call us independent contracted marketers, is because I feel like there's a lot of value that you can learn, and not only that, there's a lifetime option where if you purchase the classes, then you'll have access to it for life, which is what I've been doing. I've been studying and I've been doing this over and over again. And not only that, they provide this calculator. So if you want this calculator, go ahead and study to be a Renatus student, right? So you can hook up with me on that if you want to click the Google form link below. Now, let me just kind of go down here. So you see this is 28 grand. And so let's look at all the interest that we saved. Now, here's the thing, okay? If we replace this mortgage, instead of just moving it little pieces, like $7,000 pieces into the line of credit, if we move it into the entire mortgage here, all right, what happens? We only save 26 grand, right? And we reverse it, 94 grand. So what do you want? 26 grand to save 26 grand and 7.8 years, or 94 grand and 6.4 years? And the choice is up to you. And the funny thing is that a 30% credit card will actually beat a first lien HELOC, like a mortgage replacement. It's crazy, right? And made videos about this. I'm like so blown away by this revelation. Okay, so all right. Okay, so that's it for today. Again, now once we paid off all of our debt, and again, we paid off our mortgage in 6.5 years, I'm just going to go back here, and then I'm going to go do this. It's 45 divided by 12 plus 6.5. So that's 10.25 years to be debt-free. Okay, and let's count the debt. So that's 106 plus 300. So that's 406K, right? So 406K is how much debt we paid off. And now we're in rich people problem world, right? Because every month now we got $4,000 of savings, right? And so month one, it's going to be $4,000. It's going to be $8,000. Now month three is going to be 12 grand. And then month four is going to be 16 grand. So it's like all the savings is going to be like in your savings account. And you're like, what do I do now? Now I'm rich people problem land. See, rich people problem. What do you do? I don't know. It's got to now deploy capital, make the earth move, right? That's what rich people are thinking. They're not thinking about I'm just going to hoard money in a savings account. Maybe some people are like Scrooge McDuck, but I'm going to tell you the vast majority of rich people, much easier to raise money from them because they're always trying to make money move. right? They don't want money just sitting in a savings account. They want to make it move, okay? So, all right, well, that's it for today's Korean Atlanta mentorship. Have a great day, everybody, and we will speak next time. And I'm just going to make more videos about joining this Velocity Banking cult. I got to do that. I'm so excited. All right, have a great day, everybody.